How do you get rid of the world's most important number? What do you do when authorities say you can no longer use it? And how does the global financial sector react when the way it prices almost all of its financial products has to change because of it? I'm Scott Martin from Deloitte's Center for Regulatory Strategy, and you're listening to Regulated Radio. I've got Ed Moorby and Sherine El-Sayed with me here today to dig into some of the toughest questions we've got on LIBOR. That's right, LIBOR, the London Interbank Offered Rate. If you work in finance, you've definitely heard of it, and you probably have a sense of just how important it is for financial institutions each and every day. But as regulators have said, there is an end game to LIBOR, and the transition away from it will be a process that will carry plenty of risks for the financial sector. So all this, coming up in the next 20 minutes or less. This is the show that will give you what you need to know about one of the biggest regulatory trends of 2019. This is Regulated Radio. Some days we have to spend our time dealing with problems that only affect a small number of people. This is not one of those days. Moving off LIBOR is a challenge of a really significant scale. Financial contracts based on LIBOR run into the hundreds of trillions of dollars, to the point that some have often referred to LIBOR as the world's most important number. But nevertheless, it has been an international policy goal to move to a more robust benchmark rate since 2012. Now, a lot of work has been happening since then to make this a reality, but so much more still lies ahead to get the job done. So let's jump right in. I'm really delighted to have Ed Moorby, a partner in Deloitte's Financial Services Risk Advisory practice, joining us on the show. Ed, welcome to Regulated Radio. It's good to have you.
Great to be here, Scott.
So, Ed, could you tell us a bit more about LIBOR and why exactly it is really so important to the global financial sector?
Sure, Scott. LIBOR is a measure of the average rate at which banks are willing to borrow wholesale unsecured funds. It's calculated based on submissions from selected panel banks and is published in 5 currencies and a range of maturity terms. It's important because, essentially, LIBOR is embedded in firms' operating models. And when I say firms, I mean banks, asset managers, insurers and corporates. They use LIBOR as a reference rate in derivative, bond and loan-based contracts and consumer lending instruments like mortgages and student loans.
So, Ed, that's obviously a pretty wide net you're casting there. Do you have a specific sense of just how widespread this kind of use is?
Well, in terms of scale, it's often said that LIBOR affects contracts estimated at around $300 trillion on a gross notional basis. So to state the obvious, the scale's huge. It's also important to note that while it might be administered and regulated in the UK, LIBOR is used globally. So any withdrawal of LIBOR is a systemic issue across jurisdictions unless planned properly. Although we talk specifically about LIBOR transition on this show, there are transition initiatives underway for other interbank offered rates. For example, Euribor in the Eurozone and TIBOR in Japan.
So, Ed, I imagine an uninitiated listener might be a little bit confused by what we're talking about here. The LIBOR rate really is clearly of extreme importance to financial markets, but we're also busy trying to phase it out. Can you tell us what's so wrong with LIBOR that we can't just carry on?
Sure. So there are 2 main reasons, Scott. The first is the robustness of the rate, and the second is the panel bank's reluctance to continue contributing to LIBOR. On the first point, authorities are concerned because the underlying market that LIBOR seeks to measure is no longer sufficiently active, which creates a few problems. For example, it raises the question of whether the benchmark is actually representative of what it's seeking to measure. Another example would be that where LIBOR continues to rely on the use of expert judgment, because of limited real transaction data, it's left vulnerable to manipulation.
All right, so that's been the concern from the perspective of regulators. But you also said there was some concern on the part of the industry as well.
Yes, exactly. Where there is little actual borrowing activity, LIBOR panel banks are having to provide submissions based on judgments with little evidence to back these up, and they'd rather not be doing this. Behind the scenes, the UK Financial Conduct Authority has actually spent a lot of time persuading panel banks to continue submitting to LIBOR.
All right. Now, I also want to bring in Sherine El-Sayed, a colleague of mine in the Center for Regulatory Strategy who specializes in LIBOR transition. Sherine, welcome to the show.
It's lovely to be here, Scott.
Sherine, as we've been saying, this is a major piece of policy work for the international community with already a lot of history to it. Given that, can you just walk us through how we got to the point that we are today?
Yeah, so Scott, this has been a long time coming, really. We all know about the manipulation scandals which emerged in 2012 and beyond. And since then, regulators have been quite busy addressing the ways that they can reform benchmarks. In particular, in 2014, the Financial Stability Board set out recommendations which included the development of alternative risk-free rates. As a result, over the past few years, risk-free rates have been identified in the UK, US, Switzerland, Japan, and the Eurozone. And all are now live, with the exception of the Euro rate, which should go live in October 2019. So, Scott, Ed's point on underlying market forces and how these have drawn into question the representativeness and robustness of the rate have also been strong drivers for moving away from LIBOR.
Okay, but why is momentum for this transition picking up now?
Well, the key reason is that Andrew Bailey, who is the chief executive of the UK FCA, gave a speech in 2017. And in that speech, he announced that by the end of 2021, the FCA would no longer intend to compel or persuade panel banks to submit quotes for LIBOR. And this made clear that reliance on LIBOR could no longer be assured beyond that date.
So, Sherine, you've mentioned the term risk-free rate, and I wonder, could you tell us exactly what that means and maybe how it's different from LIBOR or any other interbank offered rate?
Sure. So risk-free rates measure overnight borrowing costs in either unsecured or secured financial markets. Some of the differences are that LIBOR and other interbank offered rates are usually published for forward-looking tenors and incorporate a bank credit risk premium, while risk-free rates don't. In many cases, risk-free rates are also fully transaction-based, and they're often administered by central banks.
All right, so as you say, Sherine, we're now in a period with much more momentum behind the regulatory activity pushing this transition forward. What's the latest on the work that regulators like the FCA have been doing to keep this all on track?
So there's been a lot of activity, Scott, but I think the most significant development was the Dear CEO letter addressed to large banks and insurers from the FCA and the Prudential Regulation Authority. The letter was sent out in September last year, and it asked boards to sign off on a comprehensive risk assessment of LIBOR transition for their firms, looking at prudential and conduct risks. They also asked firms to identify a senior manager to be accountable for and oversee LIBOR programs in accordance with the UK Senior Managers and Certification regime.
Now, that is a fairly big step for the FCA to have taken.
Yes, it's pretty significant. It sent a really strong signal that regulators are serious about transition and that they expect accountability at the highest levels within a firm.
Right. Now, Ed, both you and Sherine have mentioned that this is not just a UK or even an EU-specific initiative, but really a global one too. Have you seen regulators further afield doing similar work in parallel?
Well, it's a good question, Scott, because we've seen different approaches to driving LIBOR transition and also different approaches to implementing risk-free rates. For LIBOR transition, I think the FCA and the PRA are seen as leading the charge, and the actions they've taken, for example, the Dear CEO, clearly demonstrate this. In Switzerland, the Financial Markets Supervisory Authority is also being very proactive. For example, we have recently seen them ask firms to complete a self-assessment. The Fed in the US have also been active, but haven't taken as a direct approach as we've seen in the UK and Switzerland. Looking beyond LIBOR, I'd say the regulators in the Eurozone and Japan overall haven't driven the adoption of risk-free rates with as much vigour. And indeed, it looks likely we'll see Euribor continuing beyond 2021.
But Ed, do you think that that's going to be a problem for the market?
Well, a key concern will be that if for any reason the pace of adoption of risk-free rates is slower than anticipated, there'll be limited liquidity for these rates in the market. This could then put at risk completion of the transition away from LIBOR in the timescales that the regulators have targeted.
And just revisiting your earlier point about systemic risk, how could we conceivably get to the point where the transition to a benchmark rate, even if poorly executed, could threaten the stability of the financial system?
I think conceivably this could happen if firms, and that includes corporates as well as financial services firms, haven't prepared themselves for the cessation of LIBOR and are not ready in time to switch to using risk-free rates for new products. This would mean that they wouldn't be able to trade and manage their own financial exposure and risks in the way that they need to. It would also mean that banks wouldn't be able to meet the needs of their customers.
Okay, but have regulators been saying anything about this then?
They have, Scott. The Bank of England's Financial Policy Committee has highlighted these issues and made it clear that continued reliance on LIBOR is creating systemic risks for the medium term. From the bank's point of view, as long as the stock of LIBOR-linked sterling derivatives continues to increase, the medium-term risks to financial stability will grow.
All right. Well, that sounds like it's going to be very important to watch. Now, changing tack slightly, a lot of people talk about the big task that the sector is going to face as one of amending contracts for financial products where those contracts reference LIBOR. What are some of the options in your view that firms have when they're looking at doing this work?
The first point to note here is that there's an important distinction between amending existing contracts and issuing new ones. For new contracts, firms need to decide when they plan to start issuing new products linked to risk-free rates. This is going to vary by product type and possibly by type of customer as well, but in reality, markets in risk-free rates exist now and firms can start to move now. This ultimately goes back to the point I made earlier about systemic risk, and that as long as firms continue using LIBOR-linked long-dated products, it kicks the can down the road and can create problems later.
And you mentioned that there's different considerations for existing contracts.
I did, yes. For existing contracts, amendments would typically require a market protocol or client consents, depending on the contract type. As you'd expect, there are various initiatives underway by risk-free rate working groups and trade associations regarding the incorporation of standard market language. Overall, I'd expect firms to make good progress on this back-book transition ahead of the end of 2021. Another point to note, I think, is that the FCA and US risk-free rates working groups have raised the question of incorporating pre-cessation triggers into contracts, which would allow for a switch in reference rates where a benchmark is deemed no longer sufficiently representative. Again, this could possibly lead to different approaches across jurisdictions and could lead to problems with hedges unless a uniform approach is adopted across products.
So, Ed, is the transition then just a matter of repapering, at least for existing contracts? And if so, why would that be such a big challenge for the industry?
Unfortunately, no, it's much bigger than that. For LIBOR transition, there's no specific regulation to comply with, so market participants need to drive the transition themselves. For this to work, there needs to be strong market coordination. So, for example, banks issuing financial products are not going to transition to risk-free rates if there's no demand for products that reference these. This means that to build momentum for the transition, there needs to be extensive customer education and outreach. There are also a whole host of operational changes, accounting impacts, and conduct risks that need to be dealt with.
Okay. I'm going to pick up on conduct issues in a moment, but Sherine, I'll bring you back in for this. If you had to give us some examples, what kind of conduct risks would you say firms should be looking for when they think about LIBOR transition?
Well, a key conduct risk is that by moving legacy products from LIBOR to risk-free rate linked products, this creates so-called winners and losers. So in other words, one party ends up paying or receiving more or less than it previously did. And this could happen because the methodologies for calculating risk-free rates are different to LIBOR. But on the flip side, firms that continue to issue new contracts linked to vulnerable benchmarks, which have a real risk of permanent discontinuation in the near future, could be increasing their conduct risk and the potential for mis-selling claims. This risk would be heightened in the event of a sudden or disorderly withdrawal of a benchmark.
All right, but is there anything that firms can do to mitigate this risk ahead of time then?
Yeah, so I think the communication strategy piece that Ed touched upon earlier is really essential. As a first step, firms need to assess LIBOR exposures from both a financial and conduct risk lens, as this is going to inform their communication strategy. So to give an example, when identifying LIBOR exposures at a product-by-product and client-type level, a firm could conclude that it has a significant volume of LIBOR exposures linked to retail customers, customers deemed to be vulnerable, or simply those with far less bargaining power. In particular, this could include large exposures to retail mortgages. And in some jurisdictions, such as the US, LIBOR-linked retail mortgages are not uncommon.
Okay, Sherine. So once firms have identified their LIBOR exposure, what then? What's next?
So the next step at that point would be making a call on when to reach out to retail clients and deciding on the communication strategy itself. In my view, once firms have a good idea of their existing financial exposures and have decided on their strategy, they should really be raising awareness among their retail clients as soon as possible. And what this means is, at a minimum, firms really need to roll out initial communications and outreach programs to let clients know that change is coming and what the implications are.
So, Sherine, would you take a different approach dealing with retail versus wholesale clients?
Yes. So I think the communication strategy for retail and even SME clients is likely to be quite different to wholesale clients. So, for example, firms may need to provide more detailed or frequent disclosures to ensure that their retail clients are engaged and that they really understand how the changes might affect them. Firms should also clearly document their reasoning for taking certain decisions and justify how they've acted in the client's best interests.
Now, firms is a short word, but we're really talking about some very, very large organizations sometimes. What about internal communications within those organizations?
Yes, so this is really important too. Internally, there should be a firm-wide awareness-raising exercise, and for some staff, there should be focused training as well. There should really be enhanced monitoring of client communications, both during and post-transition.
Okay, so there's clearly quite a bit to do, and I'd say 2021 is looking quite close now. Ed, we've spoken about what firms should do, but what are you seeing in the market in terms of actual progress that firms are making?
So generally, the largest banks have made the most progress, particularly following the Dear CEO letter Sherine mentioned earlier. Programmes are mobilised, but now there is a need to complete the impact assessment and to crystallise the transition strategies. Large insurers, on the other hand, also received the letter and have been working through the issues, but I don't get the sense that there has been as much progress in getting the transition plans moving. Having said that, there have been issuances of risk-free rate-linked products from both banks and insurers. On the asset management side, firms are working through what they need to do to be ready for risk-free rate products, and some have started testing the pipes.
And what about non-financial companies, say corporates that still conduct a lot of financial activity?
Exactly, Scott. That's important too. Large corporates are increasingly looking to reduce their LIBOR exposures by moving to risk-free rates. And one way they're starting to do this is moving away from LIBOR for any new lending facilities. There is still a lot of awareness raising and progress that needs to happen among the smaller corporates, though.
So, Ed, what then, in your view, should be the top priority for firms in 2019, and what are some of the potential pinch points that could create challenges for them?
The top priority for firms is to work out what they need to do to be ready to adopt the use of risk-free rates, such as preparing new products and ensuring operationally they can actually manage risk-free rate-based products. Customer engagement's also critical, and this should move away from generic messages we've seen to date to being customer-specific. The pinch points are the outstanding issues that are still to be resolved. The one we hear most about is the term rate structure. The need for this has been challenged, and there's also concern that any term rate would not be as robust as the risk-free rate itself. Having said that, I think it is accepted that it will be needed in some niches. Other pinch points are confirmation of how accounting rules will be applied, where there's still uncertainty, and also answering questions of how the transition from LIBOR interacts with other regulations. An example here is the question of whether firms will still be meeting the best execution requirements under MiFID II if they are continuing to sell LIBOR-linked products to customers today.
Okay, so Ed, Sherine, before I let you go, in the time we've got left, I'd like to challenge both of you to go out on a limb and give me one really gutsy LIBOR prediction for 2019. Sherine, you first.
Well, for me, I think the supervisory scrutiny will grow, but I also think that there will need to be a degree of flexibility among both regulators and firms. And we're already seeing some examples of this. So despite regulators making it very clear that there is an end game for LIBOR, in a recent speech, the FCA suggested that allowing the continued publication of LIBOR post-2021 for legacy contracts could prevent otherwise unavoidable disruption in cash markets. And for firms, if term rates take time to implement or won't be implemented in certain jurisdictions, they can't just sit back and do nothing. They really need to work around these issues.
Right. And Ed, you've got the last word.
So for me, I think 2019 will be the final year where we see LIBOR issuance continuing across all product types. As we move through 2020, LIBOR products maturing beyond 2021 will cease to be issued, and the problem will finally have stopped getting worse.
All right, Ed, Sherine, thank you both for coming on Regulated Radio. And there you go. 2019 has barely started, but the work of the financial sector and the work of its regulators doesn't quite take a ski holiday in the Alps. Challenges like LIBOR will keep us all very busy. But that's why we're here. That's why we bring you Regulated Radio, to give you a short briefing on what you most need to know about the top issues. Now remember, if you like the show, hit the subscribe button to ensure you receive notifications about new episodes. And if you're already subscribed, you can give us a review on those platforms or email us with your thoughts at regulatedradio@deloitte.co.uk. We'd love to hear from you. And don't forget, if you like Regulated Radio, show us your love by recommending the show to a friend or a colleague. They'll definitely be happy you did. But that's all for now. Thanks so much for joining us, and you'll hear from us again soon.